Welcome to the show. Today, we're diving deep into the psychology of market crashes. If you've ever wondered why prices seem to collapse instantly when a headline hits, you're in the right place. We'll break down the dramatic, fear-driven event, often triggered by FUD, fear, uncertainty, and doubt. Watch carefully, because understanding this is your best defense against panic selling. 1 minute, the price is rising, and everyone is happy. The next, a negative headline hits, and the entire market seems to collapse instantly. This fear-driven event is often triggered by FUD. That stands for fear, uncertainty, and doubt. Let's start with the definition. FUD stands for fear, uncertainty, and doubt. FUD is a state of collective pessimism, or a deliberate strategy to spread negative or misleading information about an asset, a project, or the entire market. Fear is the anxiety of losing money. Uncertainty is not knowing what the future price action will be. And doubt is questioning the fundamental value or security of the asset. FUD is the opposite of FOMO, or fear of missing out. Crucially, its goal is often to push prices down so that large investors can buy assets cheaply. Now, let's look at how news acts as the crash catalyst. Markets absolutely hate uncertainty. When a major piece of negative news breaks, the price movement is amplified because it triggers this emotional FUD loop. The loop begins with a negative trigger. Uncertainty spreads as the news is vague or exaggerated. This leads to panic selling by retail investors, causing mass, emotional selling to overwhelm demand, resulting in a rapid crash. Remember, the crash is about the panic reaction, not just the bad news itself. FUD isn't always organic. Sometimes, it's a calculated manipulation strategy. While FUD can be based on real events, it is often calculated. Large traders or whales use it as a manipulation tactic. The tactic is simple. Whales spread negative rumors or pay for sensational headlines to create mass panic. Their intent is to buy the asset much lower than its current price. The result is that retail investors sell in fear at a loss, and the whales step in to buy massive quantities cheaply, later profiting as the price rises again. Understanding this manipulation helps you separate the news from the emotion. So how do you survive FUD and avoid selling at the bottom? You need a FUD-resistant mindset. First, filter the noise. Get your analysis from reliable sources, not sensational headlines or social media rumors. Second, know your fundamentals. If you truly believe in the long-term value of your investment, short-term negative news shouldn't force you to sell. Third, check the chart. Look for strong support levels. Often, the crash stops exactly where serious buyers were positioned before the news hit. FUD is inevitable in volatile markets, and it preys on a lack of conviction. Your best defense is a clear plan and the emotional discipline to not panic sell when the crowd is running for the exit. Be the rational counterparty to the emotional seller. If you want to know how to identify where those whales are buying during a crash using trading volume, just comment "Show me volume." Thanks for watching, and I'll see you in the next video. Follow me for more bite-sized insights and expert breakdowns on the ever-evolving world of cryptocurrencies.